Hey everyone, and welcome. Today we're going to tackle one of the most powerful and, honestly, one of the most misunderstood tools out there for a business owner, the S-Corporation. If you're launching a business, or maybe just thinking it's time to switch up your current structure, you're in the right place. This is for you. So let me just ask you this. When you're building a company from scratch, what do you think is the single most critical decision you have to make? I mean, is it your product, your logo, that killer marketing plan, your first hire? What is it? Well, the answer might actually surprise you, because while all of those things are obviously super important, the one foundational choice that can have massive, long-term financial consequences is your tax structure. Seriously, get this wrong, and you could be leaving so much money on the table. But if you get it right, you're setting yourself up for a much smoother ride. Okay, so let's get into it. Here's the game plan for today. We're going to start with that big question every founder faces. Then we'll look at the promise of the S-Corp, what makes it so attractive. After that, we'll dive into the really crucial fine print. We'll put the S-Corp head-to-head against the alternatives, spell out the absolute deal breakers, and then wrap it all up with a super practical checklist to help guide your decision. Every single founder gets to this point, right? This big fork in the road. You've got to choose the right vehicle for your business journey. Is it going to be an LLC, a partnership, a classic C-Corp? The choice you make right here is going to dictate everything from your personal liability to, you guessed it, how you get taxed. And that leads us right to the S-Corp. Because on the surface, man, it looks like the perfect answer. It's this sort of hybrid vehicle that seems to offer the best of both worlds. It really promises to solve one of the single biggest tax headaches that incorporated businesses face. And this right here, this is the core promise. A standard C-Corp gets hit with something called double taxation. So the company pays corporate tax on its profits. Then, when it pays out those profits to you as a dividend, you pay personal income tax on that again. It's taxed twice. The S-Corp, though, just elegantly sidesteps that whole mess. It's what's known as a pass-through entity. The profits and losses literally pass right through the corporation to your personal tax return. They only get taxed once. That is a huge deal. But you know how it goes. If something sounds that good, there's usually a catch. And the S-Corp is no exception. All those amazing benefits come with a very, very strict rulebook. So the most important thing you can do is read the fine print before you even think about signing up. And wow, when they say strict, they are not kidding. Just to get in the door, you have to be a domestic U.S. corporation. You're capped at 100 shareholders. And look at who those shareholders can be. They have to be actual people or certain specific types of trusts and estates. That means no partnerships as owners, no other corporations, and this is a big one, absolutely no non-resident aliens as shareholders. To top it all off, you can only have one single class of stock. These are not suggestions, they're hard and fast rules. Okay, now for another critical piece of that fine print. This is a big one. If you're an owner and you're actually working in the business, the IRS says, guess what? You're an employee. That means you can't just take all your money out as distributions to dodge payroll taxes. You have to pay yourself a reasonable compensation, a real W-2 salary. And trust me, the IRS is watching this very, very closely. Now, here's a nasty little trap for any business thinking about converting from a C-Corp. It's called the built-in gains tax, or BIG tax for short. So imagine your C-Corp owns a building that's now worth a ton more than you paid for it. If you switch to an S-Corp and then sell that building within a certain time frame, the IRS is going to hit you with a corporate-level tax on that built-in profit. It's basically their way of making sure C-Corps don't use the S election to escape one last tax bill. And here's another potential landmine, especially for those S-Corps that used to be C-Corps. If you've got leftover earnings and profits from your C-Corp days, and you're now making a lot of passive income, we're talking things like rent, royalties, interest. If that passive income is more than 25% of your total revenue, you can get slapped with a special tax. And if that happens for 3 years in a row, poof, the IRS can automatically terminate your S-Corp status. This is another one of those subtle but important differences. In a C-Corp, stuff like health insurance that the company pays for its employees is usually a tax-free benefit. But for an S-Corp owner who has more than a 2% stake in the company, those same benefits are generally considered taxable income. It's a detail, for sure, but those details can really add up. So with all those rules, traps, and little details in mind, how does the S-Corp actually measure up against the other options out there? Well, let's put it in the ring for a head-to-head showdown with a partnership or LLC and a C-Corp. This table right here is where the rubber meets the road. Look at how profits are split. For an S-Corp, it's totally rigid.
You get distributions based strictly on what percentage of stock you own. A partnership, though, it's super flexible. You can create all sorts of special allocations. Then there's owner eligibility. We just saw how restricted the S-Corp is, while the others are wide open. Fringe benefits? Not so great for S-Corp owners. And finally, holding on to earnings in the company. C-Corps are designed for that. For an S-Corp, it can be risky because of that passive income tax we just talked about. You can see there are clear trade-offs with every single choice.
All right, let's make this even simpler. Forget the gray areas for a second. Based on everything we've just covered, here are some crystal clear, bright red line deal breakers. If any of these sound like your situation, you should probably start looking at other options right away. First and foremost, think about your investors. If you ever plan on having foreign owners who are non-resident aliens, or if another corporation or partnership wants to invest, the S-Corp is an immediate no-go. It's an automatic disqualifier. End of story. Second, think about how you need to split the profits. S-Corps demand that every single distribution is pro rata. That means it's based on the number of shares you own, period. If you have a complex deal where one partner gets a different percentage of profits than another, you need the flexibility of a partnership. An S-Corp just can't do that. Third, we're back to that passive income tax. If your business used to be a C-Corp and now it generates a lot of income from things like rent, royalties, or investments, the S-Corp structure is basically a ticking time bomb. It could easily lead to extra taxes you don't want and even risk getting your S status terminated. And finally, let's talk compliance. That reasonable compensation rule isn't a suggestion, it's a requirement. If you're not ready and willing to set up and run a formal payroll system for the owner employees with W-2s and tax withholding and the whole shebang, then an S-Corp is absolutely the wrong choice. It's just asking for unwanted attention from the IRS. Okay, we've gone through the good, the bad, and the definite deal breakers. So now, let's pull this all together into a practical, actionable checklist. Think of this as the framework you can use to organize your thoughts and prepare for your next move. Here's how you walk through it. Step 1, just check the basics. Do you meet those strict eligibility rules we talked about? Step 2, be real with yourself. Can you actually commit to running payroll for the owners? Step 3, take a hard look at your income. Is passive income going to be a problem? Step 4, and don't forget state taxes. Some states, like California with its 1.5% entity-level tax on S-Corps, can totally change the math. And finally, step 5, look ahead. What will you need in the future? Do you need the kind of flexibility that only a partnership or C-Corp can offer? Answering these questions honestly is going to give you so much clarity. But please remember this. This is a framework for your thinking. It is not your final answer. The whole point of this explainer is to arm you with knowledge, to make you an informed client who's ready to have a really productive, high-level chat with a qualified tax professional. And so that's where we'll leave it. You've got the framework now. You know the language, you understand the concepts, you have the checklist, you get the critical trade-offs between that amazing pass-through taxation and all those strict rules. So the only question left is, now that you're armed with all this, what's the first and most important question you're going to ask your tax advisor?